privatization. So as the name, as the word itself is very clear to you, what is privatization? Privatization is companies going private. Why companies would want to go private? Companies like certain companies like public companies, whereby they have issued shares to public. So the directors who hold bulk of the shares in this company would like to buy the shares, outstanding shares from public, and want to go private. Am I right? They want to privatize. They don't want this company to be public furthermore. Okay, and sometimes privatization is nothing but policy of introducing private enterprise into industries which were previously state owned or state operated. Fine. So they want to sell it to private individuals and they want them to maintain this company. So now privatization takes three broad forms, like the deregulation of industries. If private people take the company, there is less regulation on them. Why? Because these are the people who are not answerable to anyone, whereby the shares are owned by some individual, some two or three or four, or by a family. So they run the business according to their own policies, and they need not consult anyone. No shareholders here except the family itself. Okay. So the deregulation of industries to allow private firms to compete against state-owned businesses like BSNL. Airtel is competing with BSNL. This is a public company. See, if Airtel has sold shares to public, it is also a public company. Okay, but the thing is, this is government-owned company completely. Okay, but this is like some private and some like outside shareholders also involved. Now, like they have given example deregulation of bus and coach services. Of course, previously the buses, RTC, Road Transport Corporation, they run buses between Hyderabad and Bengaluru. But many private players are also running the buses because permission has been granted to them. Okay. So like a lot of regulations were there in the previous past. Now the government, the economy wants to liberalize. That means they want to give opportunities to entrepreneurs, contracting out work to private firms. So where work was previously done by government, now they want that to be given to private people. Like many of the banks, the government is ready to sell. Many of the PSUs, public sector units, government wants to sell. Okay, and transferring the ownership of assets from state to private shareholders, private shareholders like some wealthy individuals and people. Okay, combined. The state-run companies are going in the hands of private individuals who own the bulk shares in the company. Okay, now, so privatization is good. It increases competition, reduces red tapeism, like no bureaucracy is involved now, and they work based upon their own policies. So the decision making is very fast here. Okay, and like against privatization, see, if Indian Railways goes in the hands of some private players, so what do you think? Hyderabad to Delhi tickets will be very costly. Okay, if it is maintained by private individual, of course the services would be better than the government services, because here state like the state machinery is such kind whereby all the departments are interlinked, and the government's services how they would be. But if it goes in private hands, the things can be very like what we say standard, and they would kind of give better services than the government, and they would be more concerned, because since they want to make profits, they are not service, they don't want to do to give some subsidized services to people. Okay, they are not the companies formed in that with that motive, whereby government companies are with the motive of giving services to people. Like if there is some four routes, the bus there are four routes in which the Road Transport Corporation is running its buses. Three routes are profitable, fourth route there is no profit at all, but still they have to run the buses in this route. Why they have to run the buses in this route? Understood fact. Because here the motive is to give Here the motive is to give service, okay, rather than making profits. Now, so state-run companies are more like less profit motive and more public interest they have, and encouraging private competition to state-run industries might be inadvisable, where significant economies of scale can be achieved by monopoly operations. There is also an argument that privatized business try to use their market power to create monopolies and drive up prices. That also they do. What government can do for the businesses, like in Hyderabad there is high tech city, this, and this high tech city is like it's a software park, it's a special economic zone, okay, and for software companies, if anyone wants to open their company there, they can open it, and government will aid them with very they'll give the land and resources at a very low and cheaper rates, okay, and like governments give grants in various forms, like they reduce taxes, they waive off the taxes at times, and they give grants to the companies. Certain sectors they give grants so that those sectors can survive, okay. And then green policies, we want sustainable development, we don't want polluters, we want a strong and strict policy against these polluters. We want them to follow the environmental laws of the nation, and if they follow, they get good rankings, okay. And people also want to invest in companies which are which think about the public in general, which want to run their organizations and earn profits, but also they have a policy whereby they don't want to pollute the environment, fine. So they are green companies with green policies, and like they don't want to pollute and put certain machinery and reduce the pollution, okay, or else they will be penalized. They will be kind of for breaking the environmental laws, they have to be penalized, fine. More taxes have to be levied, more fines, penalties have to be levied on them. So all the waste, whatever the companies they discharge, they release, has to be again recycled. I mean to say, again, the waste disposal, whatever is recycled, that means that has to be purified, or like that pollutant should not be released in the environment, or else it is going to impact the citizens. Am I right? So there is a factory here nearby the residential area, and they are discharging all the pollutants in the underground. So that is polluting the groundwater. They are releasing this in the rivers, lakes. That is polluting the groundwater. That is polluting the lakes. And people who get the water from these resources, kind of they get polluted water. Am I right? That is impacting their health. So these companies should be penalized. So environment friendly policies should be there in the business. That should be a part of the policy making in a company. Managers should think about it. They should come with good products, like user friendly products, and recyclable products, and environment friendly products, etc. Corporate governance regulations. See, to rule the corporate sector, like government forms certain rules and regulations. So to govern us, government for make certain rules and certain laws, and they also have strong regulation to regulate the people. Like if there's a traffic signal here, and you cannot break this traffic signal, understood fact. Why? Because you will be penalized for that. There will be penalty for it. If these rules of traffic signals were not existing, then people would jump the signal on daily basis. There could be a chaos. So that kind of fool's paradise and banana republic we don't want. We want a nation with rules and regulations. So in the same way, to regulate the corporate sector, corporate governance rules have been made, like corporate laws or company laws, environmental laws, tax laws, labor laws, contract act, negotiable instrument act, industrial laws, okay, and all kind of like security laws. then following the stock exchange commission guidelines and regulations set up by them, following the reporting standards to prepare the reports, following the audit standards to do the audit. So all this have to be followed. If these are all followed by a company, never ever there will be a problem. Environmental laws, etc. Okay, I'm entering into the chapter number 3. Financial markets and money markets and institutions. See, financial intermediaries are nothing but, see, this is a person who wants to buy a house, and this is a organization, sorry, which has like surplus money. And how these guys got a surplus money? This organization's name is bank. So what happens? Let's see. So this guy is needy for money. So in this way, I can just make a diagram. This is a bank, and these are the people who deposit money in the bank because they have surplus. They earn some salary, and after meeting all their monthly expenses, they have savings and they want to save that in the bank. Okay, and there are some companies, corporations, big corporations like insurance companies, etc. They even deposit their money in the banks. They maintain account in banks. And there are certain people who want to buy houses. There are certain people who want to buy houses. There are certain companies which want finances to start new companies or acquire some other companies or start a new project, etc. So these people deposit, and these people are depositing. So these people are depositing in the sense bank is borrowing here. Am I right? Bank is borrowing here, kind of. So bank will pay them 4% interest, and bank is lending them, these needy people, in form of loans. Okay, so bank and these guys are borrowing from bank. So here depositors, they lend to bank. That means bank borrow from depositors, and here bank lends to the people who want loans, and these people, they borrow money from bank in form of loans. Okay, and what these people pay to bank is like 8%, for example. So banks earnings are the differential, interest rate differential, 8% and 4%. So 4% is what the interest rate differential that goes to bank. That is the bank's earnings, correct? So this bank is here a financial intermediary. Fine. So let's see what the theory says. Financial intermediary links those with surplus funds. Did I say the same thing? Example, lenders, to those with fund deficits, that is the potential borrowers, thus providing aggregation and economies of scale. So the many people, they deposit here. So in totality, they have a lot of money, and they can lend it to people who want, and like economies of scale. What is happening is, like, one organization is doing the entire task. Risk pooling, yes. If any one of the lenders, borrowers, if any one of the borrowers, they default, the risk is passed on to all the other borrowers by increasing the interest rates or something else. Maturity transformation. Now they give loan on some maturities of 20 years, 30 years, 25 years, etc. So let's see, financial intermediaries institution bringing together providers and users of finance. And okay, like we have discussed right now, these people deposit, these people borrow. So the same diagram, person, he deposits in the bank, bank gives the money to company. Okay, this is the deficit in it, it's a surplus in it. This savings are deposited in intermediary, and these are again given to these guys. Now, so here you can see some of the examples of financial retail banks. There are many retail banks in India, SDFC, ICICI, etc. And investment banks like JP Morgan and Bank of America, HSBC, These guys, they don't accept deposits. Like, see, HSBC, you may be asking a question. HSBC is a bank. Okay. See, there are many companies. HSBC does the investment banking function. Normally, they are banks even. So, see, there are like they also run their mutual fund. All things they do. Lot of things by the name of HSBC, but this is a different company. This is a different company. See, HDFC is a bank. HDFC Housing Limited is different. That is solely dealing with the housing finance. So the names would be under the ambit of HDFC, but just a minute, excuse me. Excuse me. Yeah. So investment banks, yeah. So they do a lot of functions. They accept deposits from public by HSBC Bank Limited name, and they also do investment banking functions. Okay. So what does an investment bank does? Investment bank assists companies for raising funds for them. So either what these investment banks do is, see, if you are very much interested in investment banking and the functionality, I will send you a video separately. You watch that. So investment banks, what they do, suppose there is like Tata, and Tata wants to raise finance, like they want to sell their equity to public. They also want to sell their bonds to public, for example. So they can do it directly, or they can hire the services of this investment bank. So this investment bank could do that for them, or else these investment banks, sometimes they can do an outright purchase of all this. That means they can purchase at a cheaper rate these shares and sell it to public, and immediately they can like fulfill the funding needs of the company, their client. Okay. And the investment banks do a lot of functionalities, and that is not there in your what is the syllabus. So see, you can see here, offer services and advice to large clients such as governments or major organizations. So here investment bank also give advices to Tata what to be done for raising their equity or finance, and these guys get a very hefty commission for all this. Mutual society offer banking facilities to its members and those owned by its members. For example, building societies. See, you have like societies. Now you see a gated community. So gated communities also have some funds. They maintain some funds, so you can put their money in that also. Okay. And in India things are different. In UK things are different. Institutional investors like pension funds. Like in India we have LIC, UTI, Unit Trust of India. These are very big companies. These are pension funds. So people deposit their money in these companies, and they take pension funds. So they deposit. See, suppose you are working in some company. So suppose you are working in HDFC Bank. So you will get a salary of suppose 50,000, for example. So in this there will be like pension fund. So this company HDFC Bank will say that we are taking this kind of services for you, as per which we will just deposit 2500. There are see different plans. Now don't google out and come to me and ask me, sir, you are saying this and that. So there are different plans. One plan is like only the person who is taking this fund, that is the employee, will only do the contribution. In one, employee and employer both will do the contribution. So these 2500, they'll the employer would pay. So employer would pay in the sense they'll not give in the form of salary, but they'll just deposit in this fund. And when you retire, you get a lump sum amount of suppose 50 lakhs, for example. Because this money, whatever the contribution of the employer and employee, is going in pension fund. What this pension fund company would do, they will invest it in the market. by making a portfolio. That means they'll purchase some mutual funds or in government securities, etc. Okay, so they will also get returns on that. So it will accumulate your money, your contribution would accumulate and become 50 lakhs when you retire. So this 50 lakhs will can be given to you in perpetuity, like lifelong. It can be given you in the form of pension. Like they'll decide like, okay, you should get 2 lakhs per annum till your lifetime. Okay, and if the person dies, then the legal hire, that means wife or son or wife, generally I don't think son would get, but this 50 lakhs is what they are supposed to get, their family, the nominees. Okay, so 20 lakhs, 2 lakhs per annum, for example, and this, if you want, they can divide it in monthly installments or they can give you lump sum. It's your wish. Okay, for example, benefits of financial intermediation. What is happening? The people who have surplus, they are depositing. The people who have needy, they are getting. And in this way, the economy also like moves in a swift pace. Why? Because these people who deposit get returns, and in the sense they get returns. See, today the financial intermediation is not only restricted towards bank. There are many mutual fund companies, so they also take money from you and they create a portfolio and they give you a fund. That fund has a net asset value, and on that fund you will be getting returns. Am I right? You will be generating 14 to 15% returns every year. So this is also kind of an intermediation whereby you are, instead of putting your money in bank, you are investing in mutual funds. And what is happening? The companies are getting companies are able to sell their stocks or raise funds. Okay, so these mutual fund company would do that for the companies. So these are taking money from the people who have surplus and giving it to the needy. So these are financial intermediaries, mutual fund companies. Fine. If you want, I can give you a video for this also. Now, so financial intermediation has all this. So what is happening? First of all, the people who are needy are getting the funds. People who have surplus, they're getting a platform to invest, and the people who have got the funds, they can run their organization, create more jobs, pay salaries. The people who get salaries pay taxes to the government. In this, the government also gets money and they develop, and the economy booms. Okay, and like kind of with this, like things are going normally fine, and the people they get like guaranteed returns because they have invested their money in diversified portfolios, or they have put their money in the banks. Okay, and things go smoothly in this way. Now let's see a small diagram. Here are the financial intermediaries like bank, mutual funds, mutual fund companies, etc. So you know this. These are the people who have surplus. They put their money into banks or markets, and these are the needy people. They get funds. Okay, uh, and in this way the intermediation happens. So like the see, there are various ways actually. I said you like through like investment banks. Okay, so financial markets, again I can divide into money market and whereby short-term instruments would be sold, and capital markets whereby long-term like bonds or those things will be sold to raise funds. They can do it with the help of an intermediary like investment bank, or directly also they can sell in the market to people, securities. Okay, and raise funds for the company. So here also same thing is happening. The intermediation process nothing but taking the money from the people who have surplus and giving it to the needy. That's it. And then these guys who are needy would invest this in the business and earn returns and pass on the benefits what they promise to the people who are needy. Okay. Now, so please don't misinterpret. Only don't consider banks are the only intermediaries. I told you mutual fund companies. Mutual fund companies, what they do? They will buy all the stocks, bonds of all the companies. They'll create a portfolio of that and sell that, and then whatever the portfolio they have, they will see how much assets they have, the net asset value, and they will see how many people are there. They'll divide that total amount between the people in form of funds or stocks, suppose mutual fund stocks. They'll give these mutual fund stocks to the people who want to invest their money in this mutual fund. Okay, and they'll pass on. So these companies will earn returns. Fine, and this mutual fund company holds all the stocks and bonds of these companies. So these companies have to pass on the returns to mutual fund company, and mutual fund company will pass on the returns to you by just charging their for their services. Fine. So let's see the markets, capital markets, money markets. So capital markets issue medium term and long term capital. That means they deal with, okay, the companies who want to raise capital for medium term or long term would do that in the capital markets. And money markets, it's for the short term funding, like for less than 1 year or 1 year. Now let's see the money markets. Money markets trading short term financial instruments, and short term lending and borrowing happens here. Okay, so both the things, instruments are traded operated by the banks and other financial institutions which also issue security to you. Those securities are short term securities, and banks give you short term lending. Okay, to the borrowers. And although the money markets largely involve borrowing and lending by the banks, some large companies as well as the government are involved in money market operations. Though, so for example, if I take Tata company, and Tata company wants to raise funds for a short span of time, for example, say 270 days. So they'll issue commercial papers. Commercial paper is kind of a security which has a maturity period of 270 days, and they will issue this commercial paper to public, and till the time they'll give the maturity of 6 months, and till the time the money is not repaid, they'll pay interest to them. Okay, for raising funds. So types of market, if I say primary, where you buy, where the securities are issued for the first time, these are the fresh securities. If I say initial public offering, that happens in the primary market. Interbank market, so bank to bank lending and borrowing happens. Okay, and like SBI wants, SDFC wants to borrow from SBI, they can do it in interbank market. Euro currency market, banks lend and borrow in foreign currencies. So here euro currency is not euro, the European Union's currency, it is a foreign currency. Okay. It can be dollar or some other currency. Certificate of deposit market, market for trading in certificate of deposits like negotiable instruments like bills of exchange and all. Local authority market, like they borrow funds by issuing short term debts instruments like municipal bonds, like Amravati city. So Chandrababu Naidu has floated Amravati bonds and raised funding to develop the Amravati city. So like that it happens. Finance house market, dealing in short term loans raised for money markets by finance houses like Divani Housing Finance and many finance houses. Okay, you can check in India what are the financing houses. Intercompany market, so company to company, like direct short term lending between treasury departments of large companies. One department can take loan from another department. Okay, or commercial papers, as I said you right now. And commercial papers are issued by the companies of high repute. No, not all the companies can do that, and not all the companies would be successful in getting funding through by issuing the commercial paper. Now let's go for the capital markets. So here you can raise share capital and debt capital for your business. Okay, and it's very simple to understand. Capital markets are nothing but the stock exchanges, the main market, whereby the stocks are sold to public, and bond markets where the bonds are sold and the to public, or you create your creditors like by issuing bonds, and then that money you can use for your business. Okay, and the more loosely regulated second tier alternative investment market. This is alternative investments are like real estate market. See, apart from stock and bonds, these are the traditional investment options. So alternative investments are nothing but people want to invest in other things apart from stocks and bonds. So what can come under alternative investments? Can you tell me more? Any more examples of this? Hello?
Yes, sir.
Hello?
Yes, sir.
Yes, sir.
Can you tell me any other examples of alternative investments? Yes. So I already told you, if you want to invest in stock and bonds, those are traditional investments. But if you want to go into another things like real estate is one, then venture capital, hedge funds, and I can say commodities. Okay, these are all
Yes.
different kind of investments. Correct?
Yes, sir.
Derivatives, derivatives like futures, forwards, options, swaps. I don't know whether you have an idea or not, but don't worry, I'll explain you. Okay, these are all the alternative investment markets. And then primary and secondary markets, I already told you. If you want to raise new finance, fresh finance, it's in primary. And if you want to sell the existing investment, that means suppose A bought the shares of the company directly. Okay, now A wants to sell this to B. So this is, he bought it from primary market and he can sell it to B in secondary market, and B can sell to C. These stocks can change 10 hands. Okay. Now next point, exchange traded instruments and over the counter markets. See, exchange traded is nothing but the instruments which can trade only in stock exchange. And over the counter markets are nothing but where the instruments are not traded in stock exchange. That means you can buy it through local brokers. Okay. So over the counter is nothing but customers negotiate individual transactions like A and B. These both can make a contract. Fine. So in the sense, A can say to B that like I want to buy 10 quintals of wheat from you. I want to buy what? 10 quintals of wheat from you at the rate of 100 rupees after 3 months. So they are making a contract. So is this a negotiation happening between these two people? A negotiation happening or not?
Yeah.
So the negotiation is like he says 100, he says no, I want 90, and finally they come to a conclusion, and they are making, generally they are making a forward contract between each other, and forward contracts are always over the counter. That means these are always between two individuals. These are not regulated ones and not standardized ones. Standardized is nothing but they can change they can go for 1 quintal also, they can go for 1 kg also, they can make for any quantity. But if I say there are two parties, a buyer and a seller, and they have made a contract with each other, like the contract is like these guys have not seen each other, there's an intermediary between them, for example, and this is like stock exchange, for example. The trade happens between these two people. Okay, and the trade has to happen for some standardized quantity, like 1 metric ton of zinc, for example. Less than that they cannot form a contract. And these particular contracts what they are making, this is called futures contract, and this futures contract can trade in stock market. Okay, that means they can buy futures. Fine, these are exchange traded. That means if you want to trade in futures, okay, I am just putting it in simple ways. If you want to trade in futures, that means something you want to buy after 1 month, 2 months, or or tomorrow or today or within 1 minute or within 1 second, for example. Futures are available for everything. You want to buy something after 1 hour, so you'll be having futures available for that. I don't know whether you have an idea or not. I'm just trying to explain you. So these futures are traded through stock exchange. Okay. So you can estimate that if the contract is between two parties, it is over the counter. If the contract is between two parties, C and D, but the contract is not directly happening between them, it is happening through some media. That means through some counterparty. I can say central. This is a C and D are two counterparties. If C wants to buy, D wants to sell, but they are doing the trade between each other, not directly. They are doing it through a central counterparty, a regulated central counterparty. Okay. Institutional investors, I have already explained you, pension funds, insurance companies. These are the companies with huge funds. They have lot of money. Okay. Many people take insurance and they pay premium to the insurance companies. So these insurance companies, they have money. So what will they do? They will invest in the market. Unit trust and venture capital organizations. So these are all the capital market participants, individuals, firms, government, and intermediaries are. Now here is the clear picture. These are all intermediaries. I have already given you the example of banks, but also I have gave you the example of mutual fund companies. So banks take money from individuals, firms, and government, building societies, insurance companies in form of insurance by selling the insurance and taking premiums, unit trust or investment trust companies, stock exchanges, and venture capital organizations. These are wealthy individuals who would take money from all these people, and they would, what is that, okay, these are the suppliers now. Okay, these are surplus units. Okay, and they give money to all these intermediaries, and from here the money goes to the deficit units who are in need. Okay, that's what. I will stop till here because securitization is a concept. I will do one thing. Can I send a video of this to you today?
Yes, sir.
It's a detailed explanation given, so please go through that process, and then tomorrow we can start from international money and capital markets.
Okay, sir.
Tomorrow would be the end of this chapter. Fine.
Yeah.
Tomorrow we can finish and we can start working capital. Okay. See you tomorrow.
Thank you, sir.